And we are now live. Hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your host for this session. I do have Mike Larson and Brian here with me in the Zoom room, just waiting on David Morgan to go ahead and get started on time for their panel discussion at 4:40 p.m. Eastern Time. Thank you all so much for your patience, and I hope you've enjoyed the show so far. We have David Morgan joining us now. Hello, David. Welcome.
Hello.
Hi. Just a heads up, we are live. We're not just getting started just yet, but we'll be beginning in a couple of minutes.
Okay. My webmaster is calling me,
Hey,
probably
David.
because I'm the last one in. Hello. Hello, Mike. Hello, Brian.
Hey, Dave.
Are you there? Money Show wants you to log in. Okay, I'll just tell him I'm here.
Yes, we have David. Hooray. Everything is good. And to those of you watching us live, we will be getting started with this panel discussion now in just under 2 minutes at 4:40 p.m. Eastern Time. Thank you all so much for your patience.
Good to see you down there in Vegas, Mike, and you did a great job as always on that panel. I felt kind of honored to be in the last panel of the day, and I don't know how you saw it, but to me, it looked like crypto and precious metals were the two most interesting parts of that four-person panel. Seemed like that was most where the interest went.
Yeah, absolutely. Absolutely. I mean, people are looking for those alternatives as I was able to kick this whole event off with a conversation with Mark Mobius, and he was talking about global markets, but we wanted to cover a little bit about gold and crypto, and he just, said a lot of the younger investors he was talking to don't trust the dollar. They want alternatives and alternatives to a depreciating dollar and lost purchasing power, whether it's gold, whether it's crypto or both. Certainly seem to be in the trend that he was seeing, even from where he stands. So,
Well, Brian and I have been at this a long time, and if this is our day in the sun, we're just getting warmed up. I mean, I just got off a client call for an hour, and I wanted to get a drink of water, and I've got 10 minutes. I better get it. But he said, "Well, what's going on with Hecla and Coeur d'Alene?" I said, "They're really not that well run companies, but they're both NYSE noted to be silver companies. And they're just going crazy right now, which is confirmation that this trend is really starting to go, and it's got a long ways to go, in my view."
Absolutely. Well, on that note, gentlemen, let's get started. Hello, everyone, and welcome. For this panel discussion, Mike Larson, Money Show's editor-in-chief, will be your moderator. Mike will be joined by panelist David Morgan, publisher of the Morgan Report, and Brian London, editor of Gold Newsletter. They have a lot to share with you today, so to our live viewers, if you have any questions throughout this panel discussion, please share them in the live chat box. It's on the right-hand side next to your video player. We'll see if we have some time at the end for live Q&A. And with that said, I will hand the mic and the screen on over to our panelists.
Great, thanks, Charlotte, and thanks everyone for joining. As you could hear, we're so excited about this topic. We're already talking before we even get things started. So, great to be here with Brian and David. I'm fortunate enough to see these guys and talk to them at various events over the years, and certainly, with what's going on in the markets right now, it's an exciting time for investors. There's a lot of information and ground to cover. So I want to dive right in with the caveat that I always say some people tune into part of these events and then have to leave and come back later and so on. So if somebody missed either of your presentations or anything you've had to say so far, Brian and David, I wanted to just get briefly kind of your 30,000 foot up view of what's going on in precious metals. And Brian, I'll start with you. What are you seeing out there, big picture?
Yeah, the big picture, I think, and in my presentation, I tried to set up the fundamentals of what the drivers are of this market. They are monetary. Any long-standing bull market in gold has always been monetary in its foundation and its drivers. And this market seems to be just like the 70s and just like the 2000s. And that implies some multiple off of the bottom, which was around $1,050 in December 2015, meaning that at the end of this cycle, we will get somewhere between $6,000 to $8,000 on the gold price. And there's a long shot there that if there's some kind of reset where the dollar and other fiat currencies are reattached to gold somehow, some kind of a gold backing, there's a chance it could go much higher than that. And this is a unique opportunity of the way I count them, 3 previous bull markets in gold since 1971. This one's unique in that gold led and the other leveraged investments or sectors, silver and mining stocks, lagged because central banks have driven it, and they don't buy mining stocks and silver. That gives us an advantage we never had before, frankly. Before, you would have to bet on the fact that there was going to be a bull market in gold before you tried to leverage them with mining stocks and silver. Now that risk factor has been solved for us. We are in a bull market. We know it's a secular bull market. And yet mining stocks by many measures are still, even though they've doubled or more, are still near long-term lows, and silver has just begun to move. So you could not ask for a better setup. I call it a generational opportunity. And if you're not positioned, you're doing yourself a big disservice by staying out of this sector.
Yeah. And David, same question to you. I mean, Brian's talked about gold and how for a while silver and mining stocks weren't really participating. That is certainly changing and changing quickly. What are you seeing in sort of your neck of the woods, and what do you think some of the driving factors are there?
Well, I think Brian covered it quite well. I'll just focus on silver. I mean, my lecture earlier today was silver critical metal for the next decade. And silver's, has 2 functions, really. One is money, but primarily these days it's industrial use, and it's up to like 60, some say 70% of the total market. And we're in a situation going forward where we're in what James Dine, the late great James Dine, the original gold bug, said is a natural corner. We all know, or most of us know, what cornering the market means. Whether the Hunts try to do that deliberately or not, they're accused of it. But James Dine definition of a natural corner means that the industrial offtake alone, in other words, what's required to function a modern technological society, demand on the silver supply will be greater than the mining supply at some point, and will naturally take up the above ground stockpile to theoretically zero over time. And that's what we're seeing here right now, based on the work that I got from the Silver Institute that connected me with Matt Watson. I think I showed it with Brian on one of our other teleseminars that we did some months back, but it's pretty interesting to contemplate that, which means that any monetary demand on top of the industrial demand will basically eat up the above ground stockpile theoretically even faster.
Yeah, Mike, I would add to that, to what Dave says, that I have always dismissed really kind of out of hand industrial demand for silver, because my view has always been that it's monetary demand that makes up most of its, or can be credited from the vast majority of its value. But what Dave says is absolutely true. I've really come to realize and kind of change my stance that if in fact industrial demand takes all the available supplies off the market, well, then that monetary demand that sets the price on the margins will have a much larger effect when there's no supply to even attempt to satisfy it. So yeah, it is an amazing situation that's going to develop in silver now and over the next 5 years in particular.
Got it. Well, I know this. We're here theoretically to talk about silver gold manipulation, and I definitely want to get to that. But since we're kind of progressing through metals, we're talking about gold, silver, other metals like platinum, palladium that really weren't doing anything again during the early phase of this cycle have started to move. What do you think's beyond or behind that new driver, that new part of the market that again is not up as much as some of the other metals, but is starting to try and play a little catch up here?
I'll start on that one. I've been writing about the platinum fundamentals in the Morgan Report, the premium service, the paid service for, probably 6, 7, 8 months before it went anywhere. And then in the April issue of this year, I said gold has plateaued at 3,500. It's going to stay there and go sideways for the entire summer, if not longer, which is exactly what happened. But, I'm not always that accurate. But Brian knows my track record. He knows it's pretty good. And I said, right now, the thing to do is to swap some gold to platinum, or if you're going to buy something new, buy platinum or silver. But, if you're looking short term, you don't really want to add to your gold position. So we got into platinum at around 950 to 1,000, and I built a position, and it's up 50%. So it's actually outperformed both silver and and gold to this point in time. Platinum is such a small market. Why platinum, palladium are even in the futures markets, I really don't know, but they are. And platinum has been in a deficit for some time. Palladium's already had its day in the sun. It will probably come back, but not to the level that platinum will, because it plays into the hydrogen economy. Yeah. And that's something that it really isn't talked about very much. So there's something about platinum as a catalyst that probably has a strengthening going forward. Plus, most platinum mines are located in South Africa, 70%. So unfortunately, or fortunately, depending how you view it, whenever you have a consolidation like that, it's a detriment, because you want diversification. We diversify our portfolios to mitigate risk. If, for example, all the platinum came out of South Africa, it doesn't, but the majority does, and there's an issue with power, which there is, if there's an issue politically, which there is, if there's more cumbersome to get to the element platinum because you got to go deeper and deeper, which means it's hotter and harder. It's hotter and hotter, which means more cooling, more energy to cool off the mine or the miners. All that adds to the cost. And it wouldn't take much of a disruption for the platinum group metals to be encumbered in several ways. And that's actually a plus if you're a platinum investor. And knowing that it takes about $1,250 to mine an ounce of platinum for an all-in sustaining cost, and I was buying it at under 1,000, I was turning to be one of the most profitable, best allocated platinum miners on the planet. Now, I don't have millions at my disposal or billions, but for intellectual integrity's sake, yeah, I mine platinum better than most of the best platinum miners in the world, because I was buying it off the shelf, and platinum is denser than gold. I mean, I don't know, I've probably seen one, Mike, but not many people have, but a platinum coin, 1 ounce, is pretty doggone small because they're very dense. So anyway, I did it personally because of my age. I wanted the most upside but lowest risk I could find. And at $1,000 when it costs $1,250, that's pretty low risk. So that's why I went in, and I'm glad I did.
Sounds good. What about you, Brian? What would you add to that?
Yeah, that was a great call by Dave, and frankly, I missed it because I've been somewhat dismissive. Seems like I'm dismissing a lot of important things here, but I get some things right. I've been kind of dismissive of the platinum and palladium story because, they have a history as precious metals, but whatever monetary luster or cachet that they had over in previously has kind of dissipated over the years. They are industrial metals, but like a lot of industrial metals, a lot of base metals, and a lot of energy metals, et cetera, across the wide spectrum, there are great bullish stories for those metals right now. That are entirely different and separate from the monetary fundamentals for gold and silver. And for platinum, as they've said, people are somewhat dismissive, other than me, for other reasons of the PGMs, because they've been associated with internal combustion engines for so long, for catalytic converters, and everybody hyped onto the electric vehicle bandwagon. Well, in fact, ICE demand, internal combustion engine demand, is still growing, and there are other uses for the metals. But it's primarily a supply story for those metals. They are not produced in, say, the garden spots of the world. So that's a big risk factor and a supply constraint at the same time that demand is growing. So great call by Dave. I wish he would have told me about it at the time. And although he told a lot of people, I wish he would have beat me about the ears and told me to follow him into that trade.
Well, if I had a hat, I'd tip it to him right here as we're speaking. But certainly, great call there. Absolutely. Let me try and cover some of what, again, the ostensible name of the session is about manipulation in silver and gold. I mean, again, I know back in the day when central banks in the late 1990s were selling gold and everybody was talking about, oh, they're just trying to manipulate the price lower and things like that. How has the world changed? Has it not changed? What are you seeing out there? Because frankly, when I look at price charts, I say, if somebody's trying to manipulate this thing, they're doing a pretty lousy job of it.
Yeah, I would agree with that. I've never been a big believer that there are forces out there, powers that be, that are manipulating the gold price on a daily basis, within a few dollars here and there, and hitting their targets and the like. I'm not a big believer in government efficiency. I don't think they could do that if they wanted to. But at key turning points, they actually have. I mean, the gold pool of the 1960s, the treasury sales of the 1970s, overt attempts to corral the gold price. So you would think that they would be very willing to do it covertly as well. We published the work of a guy named Frank Veneroso in the late 90s, who did just extraordinary seminal research on how bullion banks were borrowing gold from central banks and selling that gold immediately in the market, using the proceeds to buy U.S. treasuries and using those treasuries as collateral for riskier bets on margin in at that time booming tech stocks and the like. And so a lot of the gold in central bank vaults had been replaced by IOUs, perhaps even in U.S. vaults. And I think that, where we've never seen any kind of verification over the years whether that gold has ever been repaid. And I think that some of the furious rallies that we've seen over the last 18 months, and even very recently over the past few weeks, may have some basis in gold trying to get back where it should have been all along. Their central banks are obviously buying gold to boost their gold reserves. I think in some cases they're buying gold to replenish their gold reserves. And I would not rule out the U.S. from that. I posted a chart today on X that, I've just started thinking literally today that this latest rally has been so violent. Somebody is buying gold, something's going on. And it's interesting to me that earlier this year, in February, actually, as the chart shows, we had the administration and Elon Musk and Trump, everybody talking about an audit of Fort Knox, and then radio silence. And if you look at the gold price since then, it's just taken off, other than, that long summer period where we traded sideways. But the price took off as soon as they shut their mouths about an audit of Fort Knox. So, probably a coincidence. Who knows? The topic of this panel is manipulation. So there's some at least circumstantial evidence that something's going on in this kind of a weird coincidence.
I actually just shared that, so hopefully you can see that out there in the audience. I'll stop it now, but now that we had a chance to take a look. Dave, what would you add to that from sort of what you've seen in the silver market over the years?
Yeah, I actually made up a couple of charts. Can I share my screen, or should I share it or just verbalize it?
Let's see. If you do have the share tab, the green arrow in the
Yep,
middle of the
I've
bottom,
got
you
it
should have
there.
that.
Share screen 2. If I hit F5, oh, these computers, how do they do this to me? Not sure. There we go. So you're seeing my screen now?
Oh, let's see. Usually there's one last time you have to press a little blue button that says share at the bottom once you've picked the screen. So if you didn't do that, I don't see it yet, but that may be because I'm
I see
hosting.
it. I didn't hit share.
Yeah,
Okay,
not just yet.
now.
Okay, now.
Here it
All right,
comes.
so now I
There we
hit
are.
F5, and you should have it.
Let's see. I've got a little case for manipulation. Yes, it's on my screen now.
So there was somebody on X or somebody's. I knew them both very well, and there was kind of a challenge that Bob will argue against anybody that there's no manipulation in the silver market, or words to that effect. And a few days or weeks go by. I'm on X kind of periodically. I'm there for hours, and then I don't look at it for 2 days. But anyway, see, no one's come forward. Therefore, there isn't any manipulation. Well, that's illogical. So I wrote him and I said, my contention from day one has been, you cannot manipulate the long-term trend. But within the long-term trend, there are times where you can manage the price. Look at the London gold pool, for example. That was put together to keep the price of gold around $35 the ounce, and it failed. So anyway, not to give you a big history lesson. So the debates around have been whether, I call it managed, which is dismissed as speculation, and there's theories and rumors, but the spoofing thing has gone on and on. So I did it because I was asked to do this some time ago for a civil suit. So Exhibit A, multi-year, and I'll say manipulation in precious metals. The Justice Department has secured felony convictions against JP Morgan. And some of these guys have gone to jail. So that's one exhibit. Another one is that in 2020, JP Morgan had a deferred prosecution agreement and paid $920 million. That's 0.92 billion for the largest spoofing related penalty ever, with regulators stating the bank's illegal trading significantly harmed market participants. Exhibit C, Deutsche Bank settled US. And it just goes on and on. I mean, I had several exhibits. Exhibit D, Barclays Bank. Brian might have forgotten about that one. And then we've got the CFTC and the Department of Justice brought the coordinated sweep against Deutsche Bank, HSBC, and UBS. And individual traders for spoofing the precious metals. Exhibit F, 2014, the LBMA disputed. And so I come down to the basics here. And this is where I would get in an argument with, let's say, some of the more establishment-oriented analytical groups, because they would throw the lawsuit down on my desk and say, look, the word manipulation doesn't appear, and I'll say you're correct. But the word spoofing does. So what the law says is the Dodd-Frank Amendment of the Commodities Exchange Act to ban spoofing, bidding or offering with the intent to basically cancel out a market or make a bid or an offer and then cancel it. And the CFTC, I'm getting excited, defines it as a manipulative or disruptive practice. So in plain English, placing a fake size to fool the market, which is called spoofing. Several cases have gone to court and proven that it was being accomplished, is manipulation by statute, ? Because again, how defined do we want to be? We want to go back to Bill Clinton. Well, it depends what the word is, So the prosecutors say that the Department of Justice charging papers and press releases repeatedly describe the conduct as market manipulation scheme, and juries agreed. appellate courts now say the same. So calling it just spoofing, in my view, does not sanitize it. So I think I built my case. Long-term trends are in place. And to say, well, David, it really disrupted the price. Well, it did at times, but I made the argument on a recent interview, and he said, well, if they sell 6 months worth of silver supply on paper in 10 minutes, I mean, that really disrupts the market. And I said, yes, it does. But having the strong futures background that I have, guess who's on the other side of the trade when they knock it down too far? Somebody else that takes the other side. So you have to look at it both ways. You have to look at both sides of the coin. So my contention is that the market knows more than any of us. And when those incidents occur, somebody has an opportunity on the other side. So I think the market's more or less where it should be under the current conditions. And I think once the monetary fear or manic part of the market takes place, which Brian and I have waited a little bit for, and it's happening now and will gain momentum, we may see prices that Brian outlined that sound outrageous when you go back to the $252 an ounce that gold was at in the year 2000, and we see $6,000, $7,000 or $8,000 gold. That's going to sound preposterous, but I don't think it's unlikely that it'll get there. So that's my argument, and I'm sticking to it. You don't need conspiracy theories. We have convictions, fines, settlements, and structural reforms that the LBMA made. Spoofing is not as harmless as some of my compatriots will call it. It's a legal term for a manipulative practice that the regulators, the courts, and the market itself have now documented in both silver and gold. The semantics debate, in my view, is a smokescreen. The evidence speaks for itself.
I appreciate that great summary, and I think your point about what you can do in the short term, or what they, I guess, with quotes around it, can do in the short term versus long term is important to take home. I guess from a trading standpoint, I mean, you kind of got into it a little bit. As somebody who speculates or trades in this market, is there somebody who's listening to this? What can they do to avoid being manipulated? Is there any practical advice that you'd offer?
Well, yeah, I mean, running the stops is what its slang is, and that happens in all the futures markets. Basically, I mean, I'm supportive of GATA. I think they think differently about it than me. I think they're like, every day they're manipulating it. I mean, these markets, all of them. I mean, I'm talking about the equity markets. I'm talking about the futures industry. There is, let's say, less than an absolute pure free market price discovery in almost any market these days. And you can chalk that up to the way the markets are managed with the algorithms. I mean, why would someone pay millions of dollars to get their bank of computers 14 blocks closer to the New York Stock Exchange than their competitor? Because they get 2.12 milliseconds more information. They did that. So, I mean, this is the real world we live in. So you got to adapt to it. But as far as answering your question, Mike, I think the thing is to not over leverage and basically take out the middle. You want the trend to be established in your favor, and then just don't get too greedy. And if it looks like, and the commitment of traders is a pretty good indicator. It's not really accurate as for timing, but it gives you an indication. So you really don't have to take a lot of information in. You don't have to build your own algorithm to do well. I actually wrote a book years ago for one of my workshops in the Silver Summit in Coeur d'Alene. And at that time, you're not going to believe me, but I'll say it anyway. You could almost trade silver to the nickel because there were so participants in the market at that time. And what would happen is that the trading funds would run out of money, and that would be so many contracts. When the open interest got to that level of contracts, they knew they had no more money to go further into the long side, so the market would sell off, go down to the same number it started at last time, and start back up to the number it went to the time before, and you could just play the open interest back and forth. And that actually worked for some time.
Yeah.
And then as the silver market, gold market got more popular, more participants, the dynamics changed, but the theory is still pretty accurate. So, but I teach most people, stay away from the futures market. don't get involved. Stack over time. Dollar cost averaging in a bull market is the safest, soundest, and most psychologically satisfying way to go, because when the market goes down and you put in 100 or 1,000 or 10,000 a month, you're buying more when the price is low. And then when the price is high, you're buying less, which is a good investment strategy. So that's what I teach. That's what most of my participants end up doing. But for those of us that have done the futures markets, good luck.
Well, Brian, I guess in the time I have left, it's not really a manipulation question. It's more of, as you get into deeper into a bull market, obviously you have more sort of fly-by-night companies that get involved as you go from the majors to the minors to the explorers and so on. There's more risk involved for an investor. So I guess not really how to avoid manipulation, but what are some of the pointers you would give to investors watching this, that if they're stepping further sort of down that scale in terms of size and higher up on the risk scale, what do they have to do to protect themselves?
Yeah, lots to talk about there. And I talked a little bit about this in my presentation earlier, but things change in the market. Right now, it's a rising tide lifting all boats. The easy money is being made. You're going to need to get a little more selective as the time goes. Now, the mining market is, and especially the junior mining market, is notoriously inefficient. And that's a feature, not a bug. That's something you can use to your advantage. You can spend the time going to conferences like yours, like mine, and there's some other ones out there. You can subscribe to the best newsletters out there, dedicate some money to it, do your own research online, talk to a lot of opportunities to talk to the management groups from at least junior mining companies face to face and get feedback. You can do the legwork, and you can outperform the rest of the market from people who don't do that legwork. This market always leaves gems lying on the ground waiting to be picked up. Either new opportunities that it hasn't realized yet from good management groups, or companies that need to be re-rated, and the market has not yet gotten around to do that. So you need to be more selective over time. There are problems, the kinds of problems you want to have in a bull market. A lot of the people involved in this market now are getting involved weren't around in the early 2000s when there was so much money being made that capital gains were like income streams. You would invest in these junior mining stocks that would go up 3 or 4 times. They'd get bought out, or you'd sell out of that one, get into another deal early on that would go up 10 times, and another one 3 or 4, another one 5. It just built up wealth tremendously and very quickly. And the lesson there, as someone who has been sold out of speculative portfolios a couple of times in my career, the lesson is you have to dip a ladle into those capital gains as if it's an income flow. Take them out of the market. Don't leave them even in cash in your brokerage account, because then you're just going to go spending money like a kid in a candy store again. Take it out of the market, maybe put it in bullion, put it in cash, put it in real estate, do something. Make at least 2 steps before you can get it back into the next hot play. There's always another bus coming, and you're going to be tempted to jump aboard. So take money out of the market. Peel off profits as this bull market continues. There are psychological games that you play with yourself that are classic in investing in general, and that are just accelerated in this kind of a speculative market. So take care, don't get leveraged, and take profits along the way.
Shoot, I mean, I had a couple of follow-up questions, but I think you covered them before I could even ask them. So that was a spectacular answer there. Charlotte, do we have any questions? I know we're just about out of time, but if we have 1 or 2 in the queue, I want to get to it before we wrap things up.
Right. No, we do not have any questions in the chat right now. Looks like people are just focused on listening in to all of this good information.
Wonderful. Well, again, I mean, I could keep this conversation going for another hour, but people do have places to go and things to do. So I want to thank you, Brian, very much for those parting words of wisdom. David, thank you so much for your insights on silver and some of the things people need to keep in mind, especially if they're going to be trading in the futures market. Everyone who is watching this is the end of today's program. But again, we'll be back online here at the Virtual Expo tomorrow morning around 11:55 a.m. with Mark Leibovit talking about his strategies for metals, mining, and crypto. So be sure you log back in tomorrow late in the morning. Gentlemen, thank you so much for your time.
Thanks, Mike.
Thanks for having us. Thanks, Mike.